Just yesterday, the final line of defense for US stocks was completely torn apart. You think this pullback is a buy-the-dip opportunity? Wrong. This might just be the opening act of an epic collapse. Hello everyone, I'm Peter. Yesterday's price action in the US market can only be described in one word: brutal. In the minutes ahead, I'll break down the truth behind this storm across multiple deep dimensions: geopolitics, the bond market, AI, and specific sectors. No fluff today, just the core facts. I suggest you like this video before we dive in. Let's get straight to it. Panic is infecting the entire market. Hit by a double whammy of deteriorating geopolitical tensions over Greenland's sovereignty and runaway bond yields, the three major U.S. indices didn't just open lower, they exhibited a desperate one-way sell-off throughout the trading day. By the closing bell, the Nasdaq 100 plunged 2.4%, the S&P 500 dropped 2.1%, and the Dow Jones was not spared, falling 1.76%. Pay attention. This open low, trend lower pattern with zero intraday bounce is a classic sign of systemic deleveraging. It shows that big money doesn't care if current valuations are cheap. They just want cash and liquidity. When core heavyweights like the Nasdaq are sold off, regardless of cost, it means the psychological defense line of the bulls has completely shattered. The blood from the stock market is flowing frantically into the vaults of hard assets. While risk assets are being slaughtered, global safe haven capital has entered escape mode. Spot gold prices briefly surged past $4.766 per ounce, while silver's performance was even more aggressive, rapidly approaching the $95 mark. According to the latest exchange subscription data, net inflows into gold ETFs have hit a nearly 6-month high. Investors no longer trust fiat currency and are embracing physical assets instead. The intensity of this flight to safety has returned to levels seen during the 1970s oil crisis. Gold hitting $4.766 is absolutely not a number driven by retail traders. This is sovereign wealth funds and top-tier hedge funds making a doomsday hedge. Silver nearing $95 shows that both industrial and financial hedging attributes have been ignited simultaneously. Remember, in a market like this, don't use technical analysis to guess the top for gold. Amidst the widespread market carnage, the memory chip sector managed to carve out an incredibly strong independent rally. SNDK shares surged against the trend, becoming the standout performer of the session. The core logic here lies in a collective rescue by industry leaders. Samsung and SK Hynix recently made a surprise announcement that they will significantly cut NAND flash production to reverse price slumps. This move instantly shifted the industry supply-demand balance, turning market fears of excess inventory into a panic-driven hoard for future shortages. The performance of the storage sector is what I always call cyclical logic defeating the broader market. Memory chips are classic commodity semiconductors. As long as the giants reach a consensus to cut production, the price floor will be reflected in the stock price ahead of time. SNDK's contrarian surge tells us that in an extremely panicked market, smart money doesn't exit entirely. The global political and economic landscape has suffered a violent shock. Donald Trump has officially announced that he will impose punitive tariffs of 25% or more on any European country that opposes the United States' actual control over Greenland. This move was immediately condemned by the European Commission, with several major European nations stating they will launch reciprocal retaliation lists. The smoke of a trade war has spread from traditional manufacturing directly into the strategic resources of the Arctic Circle. This aggressive transactional strategy, trading tariffs for sovereignty, is essentially dismantling the diplomatic norms established since World War II. For the stock market, the concern extends far beyond mere tax expenditures. It lies in the reality that the foundation of trust between the world's two largest trading blocs, the US and Europe, has been completely reset to zero. The fixed income market experienced a massive tremor today as the 10-year Treasury yield surged during the session, officially touching the critical 4.3% psychological threshold. This volatility was battered by the overseas spillover effect of panic selling in Japanese government bonds. Global liquidity levels are dropping fast as concerns over fiscal deficits intensify. Bond market volatility has actually surpassed that of the stock market. Bond yields are the anchor for all asset pricing, and the gravity for the stock market. When the yield hits 4.3%, the question isn't just will the market fall, it's that capital must flow back to the bond market. Large pension funds and insurance institutions have mechanisms that automatically trigger a sell stocks. Buy bonds shift at these rates. If you find that your stocks have great earnings but still won't stop falling, don't be surprised. The big tech leaders, once the pillars of the U.S. market, have collectively fallen from grace. QQQ, representing tech stocks, flashed a glaring downward gap, and the technical formation is now broken. The short-term support level has shifted directly down to the $595 to $600 range. As earnings season deepens, the market's requirements for these giants have become brutally strict. Any minor flaw regarding AI ROI, R&D spending, or revenue growth triggers a stampede of institutional selling. Tech stocks are currently being punished for perfectionism. Over the past year, everyone's expectations for AI were so inflated that the stock prices became pure foam. When a core product like QQQ gaps down and fails to recover, it signals a loosening of medium to long-term holdings. Don't think the giants won't fall when liquidity dries up. They are the easiest targets for institutions looking to raise cash. Despite the disastrous performance of the major indices, internal divergence has been brutal. Netflix and 3Ms saw wildly different reactions after their earnings reports, triggering sharp volatility. Although approximately 88% of S&P 500 companies beat market expectations on both earnings and revenue, this positive news failed to translate into stock price momentum. Instead, the market reacted with cold indifference or even high-volume sell-offs following the good news. This phenomenon of good earnings but no gains is intensifying the urge for investors to exit. Good news leading to a drop is a classic characteristic of a bull market ending or the early stages of a bear market. It shows that the market's focus is no longer on how much you made last year, but on whether you can withstand the pressure of tariffs and bond yields next quarter. When an 88% beat rate can't move the needle, the news is priced in. The software SaaS sector is undergoing a deep debubbling movement. Even though overall PE ratios have dropped to historical lows, the institutional sell-off shows no signs of stopping. The core reason is that while these companies have funneled astronomical amounts of money into AI R&D over the past year, the incremental revenue generated by AI on actual balance sheets remains negligible. This severe mismatch between input and output has caused a massive crisis of confidence in the future recovery of the SaaS model. The logic for software stocks right now is cruel. Last year was about the AI dream. This year is about the AI bank account. People are realizing that while AI is powerful, its inference costs are extremely high, and many B-end customers aren't as willing to pay for it as imagined. My trading logic: I need to see an AI business for a SaaS leader actually turn a profit before the sector has a chance to reverse. Despite the short-term market carnage, the underlying foundation of the AI industry remains unshaken. Analysts point out that true computing power dividends and data moats are still firmly held by a handful of giants: Google, Amazon, and Meta. With their massive cash flows and infrastructure advantages, remain the ultimate beneficiaries of this AI revolution. Meanwhile, as geopolitical tensions drive a surge in cybersecurity threats, security giants like CrowdStrike and Cloudflare see their moats becoming even more robust, gaining a high safe haven premium. The current crash is actually a massive cleansing. It's washing out the trash stocks that were just riding the hype. The fundamental logic of AI hasn't changed. The valuations were just too expensive and needed a correction. We need to look at companies that actually control resources, like Google, the straightest student with cash, algorithms, and compute. Finally, we must issue a serious warning regarding GSEA Fannie Mae and Freddie Mac stocks. Both plummeted today, with price pullbacks that are truly staggering. As the market grows highly skeptical of the prospects for privatization through an IPO, coupled with the government's vague handling of policy details, large amounts of short-term capital have chosen to exit at any cost. This volatility has wiped out a huge number of high-leverage retail traders. The valuation logic for these stocks is facing its toughest credit test since the 2008 financial crisis. GSE stocks are currently like a money tree covered in thorns. Average investors should stay away. This is purely a policy market, a game of power politics, unless you have first-hand internal info. Buying the dip right now is a gamble with your life. Until the policy dust settles, even if it bounces 10%, I suggest you don't be tempted. Protecting your principal is always more important than chasing excess returns. The market is currently unpredictable, but I will stay glued to the screen to help you watch that 600-point line of life and death. If you found today's deep dive insights helpful for your trading logic, please make sure to give this video a like. Not only does it support me, but it also helps YouTube push this important warning to more people. One last question for everyone. In the current geopolitical climate, do you think $4.700 gold is the final craze or the floor for a new round of explosive growth? Leave your views in the comments. I'll be jumping in to join the discussion personally.